but the dollar is weakening versus foreign currencies. And obviously, if you want to look at you could say the price of gold is $2,600. The better way to look at it is a dollar is 1/2600th of an ounce. And at the start of the century, it was 1/300th of an ounce. Well, you've got the stock markets at all-time highs, yet they're going to cut rates. They've never, ever done that before. But if it's 20, if it's 40, the gold price may have to go up only fivefold or eightfold. But if it's 20%, now you're talking about gold's going to have to go up tenfold, 15, 20-fold, because it has to be big enough to back trade.
The weakening U.S. dollar is reflected in the rising price of gold, which now costs around $2,600 per ounce. However, it's more accurate to say that the dollar's value has decreased to 1/2, 600th of an ounce of gold, compared to 1/300th at the start of the century. Despite the stock market hitting record highs, there are discussions of potential interest rate cuts, something unprecedented in such a strong market. If the U.S. lowers rates significantly, the price of gold could rise dramatically, possibly fivefold or even 20-fold, to maintain the necessary value to back trade effectively. Bill Holter is a financial commentator and analyst known for his insights on precious metals, the global economy, and systemic risk in financial systems. He explains that a growing lack of confidence in the U.S. dollar is evident as even foreign central banks are shifting away from dollars and increasingly buying gold. On interest rate cuts, it's notable that the U.S. has already spent over $1 trillion on interest payments this fiscal year, with projections reaching up to $1.6 trillion next year. This rising interest expense is consuming a larger portion of tax revenues, putting more pressure on the fiscal system. Meanwhile, the unwinding of the yen carry trade has begun, and the massive size and complexity of derivatives make it hard to see the full picture. Derivatives are often described as financial weapons of mass destruction, and while estimates during the 2008 crisis suggested a global total of $600 trillion, some believe it's now over $2 quadrillion. This figure surpasses the total value of all assets on Earth, showing just how these derivatives dominate global financial systems, leading to potential systemic risks. Governments and trading houses use derivatives to manipulate asset prices, notably in gold and silver. In 1987, $6 million in futures reopened markets and fueled a rally. Silver is now heavily shorted, with 300 paper ounces for every physical one. A great reset could occur if short positions are covered or exchanges collapse, revealing true asset prices. As we present clips from the video, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell to be instantly notified every time we upload a video.
It's a lack of confidence in the dollar, if you will. You've got even foreign central banks are exiting dollars and they're publicly buyers of gold. On your initial comment about rate cuts, I find it interesting that now we've already spent over $1 trillion in interest in this fiscal year. It's going to end up at 1.1, 1.2 trillion. Next year, the number is going to be higher. It's going to be 1.4 to 1.6 in that neighborhood. And that number is only going to go higher. If you look at that number versus tax receipts, it's eating up an ever-increasing large percentage of the tax revenues. I think we already started to see it last month with the yen carry trade starting to unwind. And I mean, just because of the size of it and also the fact that you can't look at it you can't look at derivatives and logically see what the total is, who's trading with who, where the weak points are. I'm just going to say broadly, this blow up is going to be derivatives. And Warren Buffett calls them weapons of mass financial destruction. That's exactly what they are. It appears that we're told that back in 2008 that it was overestimated when it was 1.4 quadrillion. And the real number was only 600 quadrillion. And we're told that that number is still the same, which is complete bullshit. There's no way. I mean, to see a reflation in the system without derivatives expanding, that's, a ridiculous argument. The real number is, in my opinion, somewhere north of $2 quadrillion. And understand that 1 quadrillion is more than all the assets on planet Earth. So it's truly the tail wagging the dog. And big trading houses worldwide have used to price assets. If something was too high, they would use derivatives. I mean, even governments themselves, central banks themselves, would use derivatives to sell the price down. And you've seen that for many, many years in gold. You've seen it in silver. You saw it October 20th, 1987. They couldn't get the markets open that Tuesday morning. The way they got the markets open, there was one futures exchange that was trading. It got open, but there was almost no volume. And a grand whopping total of $6 million with an M. I mean, pocket change today. $6 million was used to buy the value line futures, which sparked, I don't know, the equivalent of a 50 to 150 point rally in the Dow. And then slowly but surely things started opening, and the day turned up. I think it was after 2.5 hours, they finally got markets open, and the market was up 150 points or whatever for the day. What I'm getting at is they can prop markets up by using derivatives. They can also retard markets by selling the derivatives. Like I said, with gold and silver, I mean, that's for years and years. They've dumped paper contracts to the point where now with silver, you're probably looking at somewhere in the neighborhood of 300 paper ounces are sold short for every 1 real ounce that exists. So is the proper price of silver $31 an ounce? Probably not. It's probably many, many multiples of that once those shorts are forced to cover. Or if they're not forced to cover and the exchange just ceases to exist, then there's your great reset. You will find asset prices will reprice based on cash and carry pricing.
Although Western central banks downplay gold because it's a direct competitor to paper currencies like the dollar, euro, and yen. Gold and silver, as the original forms of money, have intrinsic value, unlike paper currencies, which were initially derivatives of these precious metals. Terms like dollar and pound historically referred to weights of gold or silver. Unlike paper money, gold and silver have no counterparty risk. The speaker Bill Holter suggests that while central banks hold gold as a valuable asset, gold could face confiscation, particularly in North America. They argue that the US and Canada may nationalize gold mines to build reserves for trade, questioning the authenticity of the reported 8,300 tons of gold in places like Fort Knox. Let's dive into the interview.
Well, first, Western central banks, you have to understand that gold is the anti-dollar. So the Western central banks don't want to give any credibility to gold because it is a competitor, the direct competitor versus paper fiat currencies. They want to show you that gold is bad, dollars, yen, euros, etc. are good. As far as gold and silver, where do they fit in? They are money themselves. They are the original money. They're God's money. They are what dollars originally were derivatives of, what pounds originally were derivatives of. Think about currencies. You've got the lira, the peso, the peseta, the pound, the dollar. What do all those terms have in common? They all are a weight system. They have something to do with weight. And that weight was of silver, or that weight was of gold. And those paper currencies were originally derivatives of gold and silver. But gold and silver are the original monies. And they were the original monies because there's no liability. There's no counterparty risk. They cannot be printed. They cannot be debased. Whereas the paper currencies created by man, they can be freely printed, freely diluted, and they have been. If you had a choice of saving in a currency issued by an insolvent issuer versus saving in a currency that's backed 20%, 40%, whatever, by gold, it's got, say, oil, other commodities, something real, which would you put your money into?
Yeah, it's a no-brainer.
Would you bet on the insolvent issuer? Yeah, it's a no-brainer. So yeah, it will absolutely smoke the West. And it's also going to create a huge trade problem because, I mean, here in the United States, we don't make anything anymore. So if you've got foreigners saying, we don't trust the dollar, we don't want the dollar, we'll trade with you, but we want to trade something real for something real, what you've just done is created a huge supply deficit of goods. And what it's going to look like is a massive hyperinflation of anything and everything consumable by people in the U.S., by the West. So it's going to smoke the entire Western financial system. And I do want to just clear up because some people have said that I'm the one who came up with 40% backing. I think what they said was it'll be between 20 and 40% gold backing.
Gotcha.
Maybe it's going to only be 10 or 15%. I don't know. I have no idea. I think to me, it sounds more likely at current thought, it seems more likely to be closer to 20 than 40. Gold has been held for years and years and years. You've got central banks, obviously, that own gold. I think gold is much more likely to be looked at from a confiscation standpoint. Where I really think what they're going to do is they will more than likely, right now, the safest or the perceived safest geographical areas to own a gold mine is North America. And in my opinion, it's probably the riskiest place because I could easily see the United States and Canada nationalizing gold mines because they've got to build up a gold stockpile to try to be able to start to trade again. They've got to build up a hoard of gold. I mean, the 8,300 tons that are supposedly held at Fort Knox and West Point and the other depositories.
The weakening dollar and rising demand for gold underscore potential systemic risks, while central banks downplay gold's significance to protect fiat currencies. The possible nationalization of gold mines could signal a major shift in economic strategy. How might nationalizing gold mines impact the global economy and trade systems? Could the rise in gold prices and derivatives lead to a significant financial reset or crisis? Share your thoughts in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.